Well, Tesla is down in the early going, and the market is kind of generally up a bit. Don't really have an explanation. Half the Magnificent Seven is also down, including Nvidia, and half of the Cathie Woods are down. So an odd day as we start out because even bonds are rallying, and so the yields are going down, which should be good for all those stocks I just mentioned. Anyway, we'll check that out in much greater detail at the end of the show. Let's go ahead and take a look at what is happening in the news so far this morning. So we start out with Cern Basher. He reports that Sam Corris at ARK Invest says something small manufacturing firms will be excited to hear. Why are humans designing humanoid or generalized robots? Versatility is the answer. In contrast, a wrench excels at one task, tightening nuts and bolts, and not much else. It's not versatile or capable of performing a diverse number of tasks. I think that's kind of a bad example. I would like to use the example more of normal automation devices are designed for very specific tasks, cost hundreds of thousands, well, tens or hundreds of thousands of dollars, can't be used for anything else. So a wrench, yeah, you use a wrench for a lot of stuff. Anyway, given take that away, but the idea is still true here of what he's going to say. Based on data from the U.S. Census Bureau, ARC's research suggests that most people involved in U.S. manufacturing are employed by small firms. Yes, absolutely true. Typically, the people that work there provide a wide array of tasks, unlike those in large firms who engage in relatively repetitive tasks that may have been given way to automation and or will be in the future. Again, the big company who's making millions of something will always be able to afford the automation, even if it fails a couple of times. They can keep on trying and trying until they get it right because the numbers justify it. Small companies, not so much. If you're making 10,000 of something a year or 100,000 of something a year, you may not be able to afford the automation. Humanoid robots with generalized capabilities could level the playing field, he says, for small companies, boosting productivity and transforming the economy at scale. Now, Cern says this is a nice idea. The idea that humanoid bots could help reduce the economies of scale that larger firms have over smaller firms. One potential challenge I see for smaller firms, it may be difficult for smaller firms to get an early place in line in order to deploy these humanoid bots. It's quite likely the bot vendors will prioritize larger orders first. In that case, if that's the case, then smaller firms could be disadvantaged right out the gate. Perhaps some bot makers will allocate a certain percentage of bots to smaller firms to give them a fighting chance. So I think this is a very good analysis, an outstanding analysis from somebody who's been a small manufacturer and who's worked with small manufacturers for my entire career. And I would say this is absolutely what we'll be dealing with. But the question, well, okay, so Scott Walter responds, and this will add some nuance to it. He says, I'll push back a little on small companies being at the end of the line. This is the case with industrial robots because each sale is custom and requires a lot of engineering, and benchmarks for sales are directed towards larger accounts. He's talking about these big giant arms and all these kinds of things. But I think that's only half the reason. I gave the other half a minute ago. Smaller companies are less likely to be able to afford that $100,000 or $200,000 piece of equipment because their run rates don't justify it. But he says if humanoid bots are just a drop in, small companies are as easy to sell, easier, I would say, in a minute, as large companies, perhaps easier, he says, because large companies' purchasing departments will slow walk the contracts and demand discounts, etc. Yeah. So here's where I think the key really will be, and why I keep on suggesting that this is something that Elon and everybody else, all these 27 other makers should be looking at. Small companies will buy it like that. It just instantaneously. My small company, I only had 100 employees. I would have probably bought 5 of these bots if they were, $60,000 a year for rent. I would rent them, 5 of them for 60,000 each. If they were, 60,000 cash or 100,000 cash, I would have easily bought 2 or 3 of them because the application is so obvious. All I would have had to do is walk by and see it at a show, see some YouTube video about it or something like that, just like you probably bought your first Tesla. So anyway, I think that's very fun and interesting thing to contemplate as we get into the reality of starting shipments next year. Elon Musk was speaking about the reports yesterday that very little of the vision data that Tesla is getting now on the cars is useful for training. And he says that's an accurate analysis. This is a post on X this morning. Only about 1/10,000th of the distance driven is useful for training. 1 mile out of 10,000 or 1 minute out of 10,000 minutes is useful for training. The limiting factor for FSD progress used to be, he says, AI training compute, but now it's validation because the interventions are so rare. There you go. Good explanation of why he wants the six. The question I asked was that 2 days ago. Why does he need 6 billion miles? Oh, there you go. That's the reason. All right, a lot of conjecturing conversation this morning about the China numbers, and also a little bit broader look at what is likely to look, what the numbers overall are likely to look like in the second quarter. So Tesla Chan says that the China insured units came in at 10,900. That's kind of a middling number, not great, not awful. And then James Catt responds. He says, look, the biggest risk to the quarter two delivery number and quarter two results is Europe. It says, my baseline assumption is flat quarter on quarter because of the demand for the rear-wheel drive long-range Model Y in China. However, May is off to a soft start in the daily reporting countries. Need to keep an eye on this. Tesla sales relative to their overall and EV share in key countries such as Germany and the UK is not looking great. So now remember, Tesla Cat or James Cat, Tesla fan MTL metal, Tesla fan metal. I guess that's what that means. Anyway, he's been the most accurate month after quarter, year after year. His numbers have been the most accurate by far. So I'm going to assume that he's going to be close on this. So he says that the China numbers are uneventful. He believes the quarter over quarter gap will close in May with a comp against 2 soft weeks in February due to Chinese New Year. I'm expecting China to close the quarter flat quarter over quarter. We clearly see the effect of production cuts in the wholesale sales number. Shanghai is now a lot less profitable after the tax increase. Tesla will now try and grow sales from Berlin. He says Ginga Shanghai has excess capacity of about 30,000 units a month. And he also says that he thinks that U.S. sales will be fine in the second quarter. But what I'm left wondering after looking at all of that, and maybe I should send some kind of a note to James Cat, is what's happening with the other export markets? They just opened Chile. They've been opening Southeast Asia. You got Australia, South Korea. Are all of these markets soft? Is the whole world soft right now? And I mean that not just with regard to BEVs, but with regard to all vehicles. The only standout right now seems to be hybrids. And I've been meaning to do this analysis all year. Maybe I need to do it now. The benefits of hybrid. There are definitely benefits to hybrid, or they wouldn't be selling so well, but the benefits will be short-lived. That's the problem, is that as soon as the prices of BEVs come down another 15, 20%, hybrids will be dead, completely useless, no reason to buy them. All right, now let's turn to the general economy, or maybe I should just say, this is Randy Kirk. Hi. If you haven't hit the like button now, this is a good time to do that. If you haven't hit subscribe, do that too. Hit notify, because later today, really good show, absolutely amazing show. Tony Seba just came out with his first ever report on robotics, on human robots. It is a huge report. Cern Basher used that report. He kind of truncated it, made it easier to understand. I took that, created a video about it. That'll be out later this morning. You don't want to miss it. So hit notify so you're absolutely certain to see that. And then, of course, Brian White was on yesterday. Great show with Brian White. And then hit the Patreon down below. You can go down there, down to the description. You can hit that little button, go over to Patreon and start supporting the channel. All right. This is from Business Insider this morning. A popular recession indicator, he says popular recession indicators like the Treasury yield curve and the Conference Board's leading economic index have been signaling that we're into a downturn. They've been signaling that for over a year, for like 18 months. One of the things I keep saying is the companies have been preparing for this non-recession for 18 months. When you're that prepared, it doesn't, it helps you to not be in a panic about a recession. It means that you've probably got your finances in order, and maybe that's what's helping us not go into recession. Anyway, that may be also true for the older folks demographically that are now in the population. The older you are, the more likely you are to be more conservative about how you spend your money. So lots of reasons why this recession may be put off and put off. That's why I'm only at a 30% chance right now. Well, last week, a lesser known gauge, they say, with just as impressive a track record, joined their ranks in warning of trouble ahead in the US economy. With the release of April's jobs data last Friday, Piper Sandler has this recession indicator of the 3-month moving average of the year-over-year percentage change in unemployment persons crossing the 10% threshold. All right, that sounds really complicated. Basically, you're looking at this year's level of employment versus the same year over year. You're looking at the percentage chance and percentage change, and when that percentage change reaches 10%, then this has predicted 11 out of the last 11 downturns. This is an indicator which is similar to the SAHM, the SAM rate, which says that a recession has arrived as soon as the 3-month moving average of the unemployment rate has risen by 0.5 within a 12-month window. That gauge has been on the rise and now is very close to that at 0.37. He says he goes on to say we could already be in a recession. The firm's indicator has typically preceded the National Bureau of Economic Research recession announcements, which are delayed from the actual start dates of the recession by about 4 months. So basically, 2 months from now, we could get this statement that the second quarter was the beginning of the recession. I don't think that's the case. I think it'll be either the third or the fourth quarter if it happens, and I have that 30% chance. Many labor market indicators also show further weakness is probably coming. For example, the National Federation of Independent Business survey data on hiring plans points to rising unemployment claims, as we reported a few weeks ago. We'll be looking for that report again coming up here shortly. All right, this is from Market Watch. Oil futures are edging down again this morning after the news that Russian Deputy Prime Minister Alexander Novak says OPEC Plus could move to raise crude production, even though everything I've been reading the last couple of days is that production is at record numbers, even though demand is there for those record numbers. But that oil, we've got plenty of reserve, plenty of supply coming. Why would OPEC be adding to their production numbers? Well, and also many of the articles I was reading also reflected what I've been saying for months and months and months, is that OPEC is trying to keep the price kind of let's call it the Brent crude price, say between 80 and 95, somewhere in that range. And they've been doing a very good job of it. Anyway, earlier oil had received a modest hit as Israeli forces seized control of the Gaza side of the Rafah border. So the oil prices kind of went up, but then this news came out and that took that away. So when asked, the Russians said, look, it always depends on the current situation, the balance of supply and demand. Everything is analyzed. Now there is no need to forecast anything. We just need to look at how the market is feeling, he said. All right, so we'll see what happens with that. Let's take a look at how the markets are moving, and we'll find out what oil is doing this morning. Last I checked, it was in fact down. Let's start with, of course, as always, we'll start with Tesla. And Tesla right now, after being down earlier this morning, it is still down even more. It is down $5.86. Again, I have no idea why. Nothing. People are saying, oh, it's because what's it called? I can't even think of the name of the company that makes those that the Saudis are so excited about. Let me see here. I can get that number just a second. Yeah, the reason is because, and this is according to Barron's. Barron's is saying that the reason it's down is because, yeah, I'm so sorry. Lucid, because Lucid. I get that's such a stupid name for a car. Anyway, Lucid stock was down 8.5 in pre-market trading, and that's affecting Tesla stock. I have no idea. That makes no sense at all. And the other reason was because China numbers were not that great. I don't think that's it. But the truth is that Tesla is down, and it is down and down to $6 off right now. And there's really, I can't see what's going on that would cause that. But what we have is we've also got Nvidia down 22 points this morning. We've got Meta down, Microsoft down. Don't know, doesn't make sense. The market is generally up. The Dow is, well, NASDAQ is now down 12. Dow Jones is up 76. S&P is up 6. The Cathie Woods are all down. There you go. PayPal is up. The rest of them are down. So even though yields are going down, all of the stocks that usually would be going up because of that are going down, but not by tons. Anyway, don't know. Let's look at the percentages because many of you like those percentages. We've got the Dow Jones up 0.21. We've got the NASDAQ down 0.05, S&P up 0.13, and Tesla down 3%. It just makes no sense. All right, let's go ahead and look at the rest of the numbers. Let's go start with those bonds, which were, as I mentioned, yeah, see, they're down 4.8 basis points on the 10-year. Almost 5 basis points down to 4.441. That should be excellent for Tesla. Unless, of course, people are starting to say, this is looking recessionary, which could be a reason for the bonds being, the yields being down so much and the bond purchasing being up. The 2-year is only up 0.8% of 1 basis point, moving that yield out a bit again, the difference between the yields out again, and the 2-month is actually up 0.6 of a basis point at almost 5.4, which is putting that back up to almost 100 basis points again. That's way wider of an inversion than we've seen for weeks. It's been right around 75 basis points. Okay, I don't know. A lot of action there, not easily explained. Okay, oil does continue down a half a buck on both of them. 78 for Texas Intermediate, 82, 84, almost $5 for Brent. Natural gas up again. Natural gas, I did some digger deeping on natural gas, and natural gas, they are expecting large quantities to be needed in the future. Not necessarily, I don't know why it would be this year, but this would be partially, as we've been talking about, for the data centers. Going to need lots and lots of electricity for the EV transition, for people using more electricity in their homes and businesses, and for the data centers in particular. But we're sitting at $2.21. As mentioned before, the folks in Texas, the oil companies in Texas will love that because that's going to make oil more profitable because they get to sell the gas burn off for a higher price. Okay, we've got gold down just a bit this morning at 2,327. We have got copper down a bit this morning, sitting at $4.59, down 0.5%. And then we have got, let's see here, Apple just announced they got new iPads. We were expecting that. We have got the dollar inching up as the Aussie and the yen slide. We have got the Bitcoin up 283 at 63.3, kind of not much movement over the last few days, but kind of staying in that range. And then that is it. Let's go back, see how Tesla has moved since we last looked. We have got it now down at $6.47 down this morning. There's got to be a reason for that we're not seeing. I'm not sure what it is. Anyway, that's all. Well, I want to remind you, about the video yesterday with Brian White. Super great video, and hardly anybody saw it. Maybe you missed it. I'll put the card right there. And once again, a reminder for that video coming up a little later today, where we're going to talk about the report that Tony Seba came out with, his organization came out with on robots, on humanoid robots. You don't want to miss that one. All right. Till I see you later, it's been great talking to you.